We can no longer rely on the Reserve Bank to cut interest rates when economic growth slips. Now, it used to be thought there was a sort of automatic mechanism. The Reserve Bank had a semi-official target, 3 to 3.25%. If economic growth wasn't due to get to that, the Reserve Bank would cut interest rates, or if economic growth was above it and not due to come down to it, the Reserve Bank would push up interest rates. That was the automatic mechanism, and according to the Reserve Bank Governor at a speech in Sydney, it's gone. What used to happen was that if economic growth got too high, inflation would arise and the Reserve Bank would want to control that. If economic growth got too low, unemployment would rise and the Reserve Bank would want to control that. What it's found this year is that with economic growth well below that target, it's around 2.5% at the moment, the unemployment rate has been falling. It's been falling all year, and that's something that shouldn't happen according to its model. The Reserve Bank Governor believes the actual trend rate, trend is the word it uses, of Australian economic growth is a good deal lower. If that's the case, and the Governor believes it is the case, we can no longer automatically assume that low rates of growth will mean interest rate cuts. Interest rate cuts might well be at an end. Now, the question is what the Reserve Bank's new trend rate of economic growth is. One guess is that it's as little as 2.5%, which would mean no more rate cuts for quite some time, no more rate cuts this year. It has implications that go beyond the Reserve Bank. The government's budget forecast, the budget deficit forecasts, depend on the economic growth forecast. If the Reserve Bank will no longer support the rate of economic growth around which the budget is built, the budget deficit will come in a good deal higher. Calculations by the Parliamentary Budget Office suggest that if economic growth falls 0.5 percentage point below the forecasts in the budget, the deficit will be $10 billion a year higher than it would have been by 2020, $20 billion a year higher than it would have been by 2030. And the Reserve Bank won't help the government out. It's not a very good situation for the economy. It's not a very good situation for the budget. But the Reserve Bank has given a signal we can't rely on it, like we once thought we could, to bring interest rates down.